You are listening to the Bitcoin, Blockchain, and Crypto Podcast with your host, Alex Merced of alexmerced.com. The following is for education and entertainment purposes only and is not to be taken as investment advice. Learn how you can support this and the many other podcasts of Alex Merced by going to libertydeal.info and find ways to support the show through our sponsors and through cryptocurrency donations. Enjoy the show. Hey everybody, this is Alex Merced and you're listening to the Bitcoin, Blockchain, Crypto Podcast. And I know the episodes have been a little bit less frequent lately, but don't worry, we're going to be trying to work on that. So over the next few weeks, I want to do a series of episodes on Bitcoin ETFs, just because that's been a big thing in the news, just because the SEC just once again rejected the Winklevoss twins of Facebook fame, their second attempt to create a Bitcoin ETF. So over the next few weeks, I want to talk about sort of why that matters. So first, this episode, we're going to talk about what is an ETF. Next week, we'll talk about what a Bitcoin ETF would mean and why people care so much about the value of a Bitcoin ETF. And then in a third episode, we'll talk about sort of alternative exchange traded products that could be used to end up giving investors the same kind of exposure to cryptocurrencies. So first off, what's an exchange traded product? Now, basically, they're what's called an investment company. An investment company is a sort of a category of investment products where you take several investors' money and sort of mutually invest it. Probably the most well-known investment company is the mutual fund, which is referred to as an open-end fund. Now, what does that mean? Now, typically with like stocks and stuff like that, the way it works, it trades, meaning you buy and sell it to other investors. So the way you make money is you find another investor who will buy it from you at a higher price. And maybe that company pays you cash every once in a while and as a dividend. An open-end fund does not trade. The reason being is the way it works is that when you buy a share of a mutual fund, they literally make that share on the spot for you. So you're always buying sort of a fresh share. It's new. So what happens is that I would buy a share, that money would go into the fund, and then would just buy more of whatever they're investing in. Okay, so basically the more investors there are in the fund, the bigger the fund is, the more variety of investments it can take on. And then when I no longer want to own the fund share, I just take it back to the fund and cash it in or redeem it. So mutual funds are generally redeemable, not tradable. Okay, so what happens every day for every investment company, they have to calculate the value of the fund, which is known as the net asset value. And you would dream at that. So I buy the mutual fund one day at $5. It invests, it grows the value of its portfolio, and now it's worth $10. I can cash it in for that $10. Now, historically, what happened is that actively managed funds were very popular, meaning you put your money in a fund and you have a portfolio manager who's trying to do their best to beat the market and give you sort of exceptional returns. But the problem with that was that portfolio manager would do a lot of frequent trading to achieve those returns, which meant a lot of expenses in doing those trades, which ate up those profits. Also, that manager would ask for a higher fee. So in that case, that ate up your profits. So you may have a higher return on the portfolio, but the actual amount you kept sometimes put you not too far from when the market was to begin with. And also they have more volatile returns, because just because someone's right one year doesn't necessarily mean they're going to make the right investments next year. So you may be up 20% one year, down 10% another year, up 5% the next year, on top of all the expenses. So people started getting sour on the idea of active management. Enter Vanguard with the idea of like an index fund. And the idea here is, a lot of people statistically talk about how the S&P 500, the market as a whole, over a period of time, does okay. So they're like, how about I just take that? It's been consistent over history that the 500 largest companies seem to do well over a time span. So long as I get the return of the market, I'll be happy. So they created a mutual fund that allowed you to invest in a fund that replicates the return of an index by basically investing in the same stocks in the same proportions as the design of the stock index, the S&P 500, the Dow Jones, whatever. And this allowed investors to kind of invest in a low fee, low management fee vehicle and get sort of decent returns without taking a crazy amount of risk. So it was just like set it and forget it kind of investment. And to this day, these are still very, very popular. But the problem is mutual funds, you can't trade, which means there's certain benefits of trading. You can get long-term capital gains by trading. If you think something's going to go down, you can short it because it trades. You can buy options to sort of offset your potential risks or generate income on something that trades. But mutual funds don't trade, so none of these options are available. So someone wanted to kind of design a way to create a index fund that can trade like a stock. Generally, there is a tradable fund called a closed-end fund, like Berkshire Hathaway. That's the Warren Buffett fund. That's a closed-end fund. The problem with the closed-end fund is that its market price is completely independent of the value of the fund. So the net asset value per share could be $5 per share, but the fund is trading between investors at $8 per share. So that, or it could even be trading for less. It could be worth $5 and trading for $4. So this creates a difficulty to have a vehicle where you can actually capture that return on the index. Even though the fund itself is following the index, your ability to liquidate it for that value is not there. That's the problem with a closed-end fund. So eventually someone came up with the idea of an exchange-traded fund, which kind of mixed the two ideas. So it's open-ended in the sense that you can create new shares and redeem them, but you can only do them in large, like 50,000 share blocks. So generally it's only like the big financial institutions that actually create new ETF shares and redeem them. So for everybody else, they can trade them on exchanges, like a closed-end fund or like a stock. So this creates a market for a tradable product. And what happens is that the institutions will arbitrage the difference between the net asset value and the market price. So generally the market price will stay where the net asset value is at. So now you have a tradable product that actually does track the underlying asset and allows you to capture that index. So now that's why the initial ETF, the SPDR, SPDR, still the largest ETF today, exists. Okay, so it gives you a way to track the value of an asset or an index, etc., through a tradable product, which now can be shorted if you think the value is going to go down, which you can now buy calls and put options on in order to offset your risks. You can capture long-term gains on it because it trades like a stock. So you have all these new tax and liquidity benefits and whatnot you didn't have with your traditional index mutual fund. So ETFs have been a very big growth space for years and years and years. So that's what an ETF is, an exchange traded fund. And next week we'll talk about sort of the idea of creating a fund not based on investing in securities like stocks and bonds, but on investing in assets like gold or Bitcoin, and basically the dynamic it creates and why it matters. So I'll see you guys next week. Again, if you guys enjoy the show, make sure to become a supporter by going to patreon.com/AlexMerced. You can find all this stuff over there at bitcoinblockchaincrypto.com, where you can find my videos introducing people to crypto. You can find a link to my donation page where you can find ways to make one-time donations, crypto donations, and become a patron over there at Patreon. Basically, the more support I get, the more I am able to free up my time to do more and more frequent episodes and do more and more research in order to give you guys the best information I can. So I'll see you guys next week. Have a good one. Enjoy. Ciao.